What if I told you that some of the world's richest people didn't get rich by working more hours, but by owning tiny pieces of businesses? Every day, billions of dollars move through the stock market, yet most beginners feel it's confusing, risky, or only for experts. The truth is, the stock market is one of the most powerful wealth-building tools ever created, if you understand how it works. In the next few minutes, I'll explain the stock market in the simplest way possible, even if you've never invested before. Part 1. What the stock market actually is. At its core, the stock market is a system where people buy and sell ownership in publicly traded companies. When a business wants to grow, by building factories, expanding into new markets, hiring more employees, or developing new products, it needs significant funding. Instead of relying only on bank loans, the company can raise money by selling small ownership stakes to the public. These units of ownership are called shares or stocks. When you purchase a stock, you are not just buying a symbol on a screen. You become a partial owner of that company with a claim on a portion of its assets and future profits. If the business performs well, earns more revenue, and increases in value, the price of your shares can rise. If the company struggles, faces competition, or experiences losses, the share price can decline. Today, the stock market is mostly digital, operating through electronic exchanges and online platforms that connect millions of investors around the world instantly, allowing trades to happen within seconds. Part 2. Why companies sell stock. Instead of taking loans, companies often raise money by issuing stock because they don't have to pay it back like debt. Investors provide capital up front, and in return, they get ownership. This funding allows companies to expand faster than they could on their own. For investors, it's a chance to participate in that growth. If the business succeeds, profits increase, the company becomes more valuable, and shareholders benefit. Some companies also share profits directly through dividends, regular payments made to stockholders. So buying stock can generate wealth both through price increases and through income. Part 3. Why stock prices move. Stock prices change constantly because they reflect what millions of investors think a company is worth at any moment. If people believe a company's future is strong, maybe sales are rising or new products look promising, more buyers enter the market, pushing the price up. If investors worry about declining profits, competition, or economic problems, sellers dominate and prices fall. In simple terms, prices move based on supply and demand, influenced by expectations about the future, not just current performance. News, earnings reports, interest rates, and even global events can all affect these expectations. Part 4. The difference between investing and trading. Beginners often confuse investing with trading, but they are very different approaches. Trading focuses on short-term price movements, buying and selling quickly to profit from fluctuations. It requires time, skill, and tolerance for risk. Investing, on the other hand, is about owning businesses for the long term and allowing growth and compounding to work over years or decades. Historically, long-term investors have had much higher success rates than short-term traders. For beginners, investing is usually the safer and more sustainable path because it doesn't depend on predicting daily market movements. Part 5. How you actually make money. There are two main ways investors earn from stocks. First is capital appreciation, when you buy a stock at one price and sell it later at a higher price. Second is dividends, payments some companies distribute from their profits. Many long-term investors reinvest dividends to buy more shares, which accelerates growth through compounding. Over time, this reinvestment can produce exponential results because your returns begin generating their own returns. This is why patience is often more powerful than timing the market. Part 6. Risk and volatility. Explained. The stock market is not a straight line upward. Prices rise and fall, sometimes sharply. These fluctuations are called volatility, and they're a normal part of investing. Short-term drops can happen due to economic fears, political events, or sudden news. However, historically, Broad markets have trended upward over long periods because businesses innovate, populations grow, and productivity increases. Risk comes from uncertainty. There's no guarantee any individual company will succeed. That's why diversification, owning many companies instead of just one, is one of the most important risk reduction strategies. Part 7. What index funds are, beginner's secret weapon. Instead of picking individual stocks, many beginners start with index funds. An index fund is a single investment that owns small pieces of hundreds or even thousands of companies. Rather than trying to beat the market, you effectively become the market. This approach reduces the impact of any single company failing and provides broad exposure to economic growth. It also requires far less research and emotional decision-making. For people who don't want investing to become a full-time hobby, index funds offer simplicity, diversification, and historically strong long-term performance. Part 8. How to start investing. Getting started today is easier than ever. Most people invest through brokerage accounts, which are platforms that allow you to buy and sell securities. After opening an account, you deposit money, choose investments, and place orders. Many platforms allow fractional shares, meaning you don't need large amounts of money to begin. The most important step isn't finding the perfect stock, it's starting early and investing consistently. Regular contributions, even small ones, can grow significantly over time thanks to compounding. Part 9. Common beginner mistakes to avoid. New investors often make predictable mistakes. One is trying to get rich quickly by chasing hot stocks or trends. Another is panic selling during market drops, locking in losses instead of waiting for recovery. Many also invest without understanding what they own. Successful investing is less about intelligence and more about behavior, staying disciplined, thinking long-term, and avoiding emotional decisions. Time in the market usually beats timing the market. Part 10. Why the stock market matters for your future. Inflation slowly erodes the value of cash sitting idle. Investing allows your money to grow faster than inflation, preserving and increasing purchasing power over time. The stock market is essentially a system that channels savings into productive businesses, benefiting both companies and investors. For individuals, it can mean the difference between relying solely on income from work and building wealth that generates income on its own. In many cases, investing becomes a key component of financial independence. The stock market isn't a casino, a mystery, or a game reserved for experts. It's simply a system that allows ordinary people to own extraordinary businesses. You don't need perfect timing, insider knowledge, or huge amounts of money. Just understanding, patience, and consistency. Start small, keep learning, and let time do the heavy lifting. Because in the long run, the biggest risk isn't investing, it's never starting at all. Thanks for watching. If you found this helpful, hit like, subscribe, and comment which part of the stock market you want me to explain next. Start small, stay consistent, and watch your wealth grow.